Now think about the UK housing market. When banks increase mortgage lending, they are effectively increasing the money supply. More money chasing the same houses. That puts upward pressure on prices. This is one reason property values in the United Kingdom can rise steadily over long periods. It is not just demand, it is credit expansion. When lending expands, more money enters the economy. When lending slows, growth slows with it. That is why interest rates matter so much. When the Bank of England raises rates, borrowing becomes more expensive, which slows the creation of new money. Banks are not simply intermediaries, they are money creators. Understanding this changes how you think about debt, mortgages, inflation, and economic cycles in the United Kingdom. This is not about conspiracy, it is about mechanics. And once you understand the mechanics, you start to see the system more clearly. If you want simple explanations of how money actually works in the UK, subscribe to the Simple Ledger. New videos every week. Most people believe banks lend out the money that customers deposit. That isn't how modern banking actually works. In reality, when a bank approves a loan, it creates new money electronically. Understanding this changes how you see debt, inflation, and even house prices in the UK. Let's break it down simply. Most people imagine this. You deposit £1,000 into a bank. The bank takes that money and lends it to someone else. Simple. But that's not what happens. Banks do not move your deposit to someone else's account when they approve a mortgage or personal loan. They create a brand new deposit. Let's say you walk into a UK bank and get approved for a £200,000 mortgage. The bank does not check if it has £200,000 sitting in a vault. Instead, it creates a digital entry. On one side of its balance sheet, a loan asset of £200,000. On the other side, a deposit in your account for £200,000. New money is created. It did not exist before that moment. This is how most money in the UK economy is created, through bank lending. Now you might be wondering, isn't there a limit? Surely banks cannot just create unlimited money. And you would be right. Banks in the United Kingdom are regulated. They must hold capital against the loans they issue. They are constrained by capital requirements, risk management, and regulatory oversight. But they are not limited by the amount of physical cash sitting in a vault. That's the key distinction. Lending is constrained by rules and risk, not by deposits in the way most people imagine. This system is often described as fractional reserve banking. The idea is simple. Banks hold a fraction of deposits as reserves. The rest can support lending. In older textbook explanations, if someone deposited £1,000, a portion would be held in reserve and the remainder could be lent out. But modern banking works slightly differently. In reality, loans create deposits, not the other way around. The reserve position is managed afterwards. That's a major shift from how most people imagine the system works.